You're listening to Market Champions, a podcast on navigating the financial markets. Here's your host, Srivatsan Prakash.
This episode of Market Champions is brought to you by Simplify ETFs. For more information, visit simplify.us. No simplified funds will be discussed during this podcast. Hey guys, welcome back to another episode of Market Champions. I just wanted to remind you to like, subscribe, and leave a comment. Really helps the page grow, really helps the podcast grow. Thank you so much for your support. And now on to the interview. Hi everyone, welcome back to another episode of Market Champions. Today, I've got Paul Krake on. Paul Krake is a former hedge fund manager and is the founder of View from the Peak. And he's also the founder of Climate Transform, where he discusses climate trends and how, they impact the economy, how investors can play them, etc. And, he's got 2-3 decades of experience as an economic and political strategist. So Paul, thank you so much for being on the podcast. It's wonderful to have you here.
Sri, thank you. I don't know if I'm quite at 3 decades yet, which does date me. That does date me severely. I really don't know what to think about that. I don't know if that's a good thing or a bad thing. But thanks.
Well, no, it means that you're highly experienced, incredibly smart.
That's the way I'd like to refer to it.
Okay, we've got Paul Krake, the incredibly smart economic and political strategist. Let's forget the years. Yeah, and Paul, could you start by telling the audience a little bit about your background? Because your background is amazing because, you've worked for people like Bruce Kovner, Louis Bacon, people that, that are legends in the finance space. So, could you talk a bit about how you got into finance and then, your journey through finance and, and how you got to where you are today?
But I'm the last remnants of a deglobalized world, right? So, and what I mean by that is like, I was, after university, I was lucky enough to get a job at Macquarie Bank, which was, one of the, if you're Australian and you went to, in the early 90s when you graduated university, you hoped to go to one of 2 places, which was Bankers Trust or Macquarie Bank, and I was lucky enough to end up at Macquarie. But several years into the process, I got offered an opportunity which I just couldn't resist, which was to go and work for Goldman Sachs up in Hong Kong. And when I say I'm the last remnants of a deglobalized world, I'm a white guy who doesn't speak any Mandarin who got a job in Asia, right? And I joke with the guys who I went through the training program with up to this day, who many have had careers vastly in excess of mine, and we all joke about the fact that none of us would get a job today, right? Unilingual white guys trying to get jobs in a multicultural, multilingual world, it just doesn't cut it. And so how one gets to where I got to is through large elements of luck. And I shouldn't discount that. I don't discount that for a second. So I was lucky enough to be at Goldman for just under 5 years. Was lucky enough to lucky enough, I don't know if you call it lucky, partly work through the Asian crisis, which was a very formative time for many of us. And we were lucky enough to have a desk at Goldman in Hong Kong, which featured guys who are now household names, like Mike Novogratz was there, Adam Levinson was there, guys like Mike Daffy, who are, if you're big into the investment banking world, everyone knows who Daff is. Tim Throsby, he used to run the Barclays Investment Bank. A slew of hedge fund managers, other hedge fund managers. We were very, very lucky. So Mark Machin, who used to run CPP up until a few months ago, he was part of that crew as well. So I was very blessed to be surrounded by people who were, who ended up having just these remarkable careers, and we sort of fed on each other through what was an extraordinary time. And I think any of us who lived through the Asian crisis can make corollaries to what's going on today in different markets and the like, and that's where we are. So then after that was spent 12 years in New York, which was more capital Caxton, and then was lucky enough to have my own firm for a few years, for just on 4 years. Which was, a remarkable experience. I was lucky enough to start a fund when anyone can start a fund. It's certainly not the challenging thing which is capital raising today. So I go back to this and I'm not being humble when I say all this, but there are, people's careers have elements of luck to them, and I was lucky enough to work through those phases. So it's sort of, I have sort of macro in my blood. I always look at macro through an equity lens first, through a company lens first. And then, in 2010, after closing my fund, took a couple of years off. I started View from the Peak, which was basically how it started was I wanted to produce a research product that basically was helpful to people who had my experiences. So if you were a macro manager, an equity manager, you wanted to have research that was practical, that was actionable, that was something that was implementable. And a lot of you looked around at the time, and a lot of the research, heavy economic research, didn't have any practicality to it at all. So View from the Peak was formed out of that sort of thinking, and remains that way today, which we try to be as practical as we can. But the one thing you learn very quickly is that the idea of being long or short something is an irrelevant statement if it isn't accompanied by a time frame. So when say I'm bullish, I'm bearish, well, what the heck does that mean in the context of, is it 3 weeks, 3 years, 3 months, whatever? And I think it's very, very important when one talks about idea generation and the like that you put a time frame at the end of it, because I can be bearish on rates on a 3-week view and think that US 10-year bond yields are going sub 1% in the next 3 years type thing, those sort of things. So I think that over time I've evolved in my thinking. It's evolved to be very much how to think about time frame in the construct of every investment idea. But more to the point, the big pivot that I made personally from an investment strategy standpoint was about 4 years ago, where I sort of realized that the world didn't need another macro guy trying to punt the Fed and work out when the next Chinese stimulus was coming. So I've divided the world up into what I call mega thematics. And those mega thematics are the 4 things that I believe that if you get these 4 things right in the next 2 decades, then from a global beta standpoint across equities, bonds, credit, private equity, venture, the whole spectrum, you're going to be okay. And those 4 things in my order are: climate is 1, digitization is 2, and you can break that down in many different ways. China is 3, and demographics is 4. So all of our work revolves around those 4 mega thematics now, and we have the 2 businesses that are reflective of that, which is the US-China series, which is smaller than what it was, because the relevance of China near term is not as influential as it was. But obviously our big push with all of our resources is around climate transform, which, as it sounds, is top down climate. Is climate research in all its forms.
Got it. And when it comes to just the industry in general, and so you've been in the days of more capital, Bruce Kovner, Druckenmiller, Soros running the show. Now, how has the industry evolved? And what do you think is the future for the hedge fund industry in general? Because just from what we've seen over the last decade, people like Druckenmiller have converted their hedge fund to the family offices. We've seen John Paulson do the same thing. We've seen David Tepper do the same thing. So when it comes to the future of hedge funds, do you think that hedge funds as a whole, as a space, is slowly dying? How do you see that evolving?
No, I don't. Well, I think we've got to define hedge fund, because the word hedge fund is fairly all encompassing, right? So there's I think we've got to look at this at a strategy level. Now, I don't want to read too much into the fact that Stan Druckenmiller, multi-billionaire, David Tepper, multi-billionaire, John Paulson, multi-billionaire, said they didn't want to deal with investors anymore and started to run all their own money. I don't think that's an industry trend, right? When those guys are in the top 1,000 richest people in the world, what they do is hardly defining. That said, the macro. I think the macro space has a very dim future. And remember that the difference between a macro strategy and an equity and a credit strategy is, historically putting the equity asset class to one side. There's no fair value for many of the macro instruments that macro people trade. There's no fair value for gold. There's no fair value for the dollar. There's no fair value for rates. If bonds go from 2% to 3%, it doesn't make them X% cheaper in the eyes of many and therefore more attractive. Well, you can make that argument, but it's nowhere near the fact that, if a stock goes down by half and its fundamentals hasn't changed, then it's half as cheap, twice as cheap as it was before. So I think that the mindset between trading and owning, remember, macro people don't own assets. They rent assets, where equity people, particularly long-term holders of equities, are owners of assets. They could be activists. They could be involved in changing the fortunes of a company management and doing those sort of things. So it's owners versus renters. Renting is renting is an incredibly difficult task, and the trading elements around renting assets is vitally important. And I think the future of the macro space is incredibly dim, because no one learns how to trade anymore, right? When do you learn bid offer spread? Like, I was lucky enough to be on to work on a futures floor and to work on a SICOM desk, which was Australian overnight futures trading into the US. And you learn that you didn't buy on the bid and you don't sell on the offer, that you have to cross bid offer spread, and spread matters to profitability and slippage and all this sort of stuff. You just don't learn that anywhere now. You just don't learn that. So there's no FX desk, there's no spot FX dealers of any note anymore. Market making is all electronic, and it's all electronic, and it's just it's, you're not learning that lifeblood, which is bid offer spread. Look, I think that the notion of the hedge fund is not dead, but there certainly is going to be fee convergence between long only and hedge fund, and you've seen that to limited degrees. I mean, I think the days of the rock star analyst launching a $3 billion fund they're few and far between.
Or like breaking the Bank of England. So.
Well, no, but that's a different thing. I mean, that's taking advantage of an idiosyncratic macro event. I mean, I challenge, Stan Druckenmiller obviously has had this incredible career, but there are a lot of other people John Paulson is a good example of this. That John Paulson had one cracking trade, during the financial crisis. And please forgive me if this is incorrect, but I'm under the impression that John Paulson is a net destroyer of capital since that time. Right, so there are people who get one thing really right and ride that. There are people who are doyens in the industry: Lewis Bacon, Bruce Kovner, Stan Druckenmiller, George Soros, these sort of guys. So look, it does vary, but I think that the idea of two guys in a Bloomberg starting a hedge fund with friends and family money are dead. Those days are gone. Right, because I think that the institutionalization of the process is so entrenched that that's going to be the nature of this going forward. That it's unless you can raise $750 million out of the gate, no one's going to be interested in investing with you longer term. It's a very institutional process now.
Mm-hmm. Got it. And so now I wanted to move on and talk about the four big things that the mega thematics, as you call them. And so I wanted to start with China. And so. Okay. China's been on most people's radars, one, regarding the lockdown and what's going on there, and then two, thinking through their central bank dynamics, their housing dynamics, etc. And so, how are you thinking about China and the Chinese economy as we go forward from here?
So, but I'd say the following: that I'm not as bearish on China as most. I'm certainly not in the in the Kyle Bass world that China's going to implode, right? So let's start with the following. Why is China in my list of mega thematics? China is in my list of mega thematics because of mathematics. China will become the world's biggest economy in some stage in the next 7 to 11 years, right? Depending on growth rate, and that mathematics is very straightforward. China has 4 times the population of the United States, and therefore China will be a bigger economy in a few years' time. There is no debate there, right? And I think that there are, one of the things that I think about a lot and tell a lot, one of the first things I tell clients is never trade ideology, right? Trade ideology is a hiding to nothing, right? So whether there was a belief in, as there was in 2008, that President Obama was going to be disastrous for markets, whether it was a belief that that you couldn't invest in China because a communist government couldn't run an economy properly. These are all things that that people get wrong, and China has a lot of misconceptions around it. That it can't actually run itself properly, and I think they've done look. There is tremendous inefficiencies in the Chinese economy, but from an infrastructure standpoint and the like, China's taken 800 million people out of poverty in 4 decades, which is something that economically and socially is just unfathomable, right? So, but sort of into the here and now, the China of Xi Jinping is very much the throwback to Mao is just too elusive of a comparison. But it is a China that is more centralized around one man. The party remains dominant. You should never lose sight of the fact that Xi Jinping is only in power for life as long as the party deems that to be the case. Right now, he is a very powerful guy, but he has had a really shitty 2 years. Right between economy struggling, botched COVID. The remnants of the disastrous 4 years in US-China relations under Trump, where I'm certainly no fan of Donald Trump, but the Trump administration did hold China to account, and China, there were consequences for China in regards to that. China is a much more inward-looking economy under Xi Jinping. It is a much more delevered economy under Xi Jinping. It is the whole notion of common prosperity means that it is, as we've seen recently, a more highly regulated technology economy under Xi Jinping. But the one thing that has just amazed me with this, and again, talking about China under Xi as towards a cult of personality under him, just how little the Chinese have done to protect their citizens because of COVID. If you had have told me 5 years ago that there was going to be a pandemic and that the world's largest communist country would do the least that they possibly could from a fiscal, monetary, medical standpoint than any Western economy, you'd laugh at them, right? And yet the Chinese have done a terrible job at supporting their citizens through COVID. The zero COVID policy is a freaking disaster. I think we can all agree with that. And the thing that has really shocked me, that if Xi Jinping is this political beast that we all suspect that he is, why on earth did we not get any form of stimulus going into the party congress in October, right? I don't know why. Look, the leverage hawks have been in charge of China since 2016. Since going into towards the end of 2015, when China went into the SDR, you had a slight opening up of the capital account at that time, only to see it slam shut literally weeks later once they were into the SDR. And the Chinese have been just incredibly hawkish in regards to monetary and fiscal policy ever since. China allocated a deficit of 8% of GDP last year, budget deficit of 8% of GDP, and I think they got to 3.5. They didn't spend it, and you think to yourself, the country's in lockdown, the country's in isolation because of COVID, foreign travel completely not allowed, right? You've got supply chain issues across the board, and they don't spend the money they allocated on stuff. It's crazy, right? So, I think that, so obviously China under Xi Jinping with common prosperity is a structurally lower growth rate. But it's not devastating. It's not dire. It's not devastating. I mean, I push back on the whole thing about tech reform being the end of capitalism as we know it, right? Let's be clear. China's doing the shit that the rest of the world wished it could do, right? But I got a 15-year-old kid who's currently in the other room, whose eyes are bleeding because he's been on his gaming PC for the last 4 hours, right? Now, if he was a kid in China, he would only be allowed to play that 3 hours a day, and there wouldn't be put it this way, you implement that in the United States, and there are not, and 80% of parents are in favor of it, right? Companies like Meituan, for example, gets fined $50 million because they don't pay their drivers minimum wage. Stock's down 17% because that's an affront to capitalism. No, they weren't paying their drivers minimum wage, right? You wouldn't get away with that in California, New York, or London, right? But somehow China enforcing that regulation is some affront to capitalism. Look, I mean, China. I'll make arguments that Chinese tech regulation is remarkably sensible, and a lot of China's data privacy provisions are based on GDPR and the like. And I think what you're seeing, if we're honest about this, the place where the tech companies run amok is here in the United States, right? Because there is no regulation around a lot of, there's outside of California, very few data privacy provisions and all this sort of stuff. So I think that the notion that China is somehow fragile, is somehow facing crisis or peril, I think is very flawed. We can talk a little bit about about Taiwan if you wish, but I think that Taiwan because of Russia has never been safer, right? And I think the big picture, the West with their dollarized sanctions on Russia has shown China exactly what will happen in the event of a military style takeover of Taiwan. And China is still very reliant on its dollars. Again, the reason that Gazprom and Rosneft and like that faced default, they weren't defaulting in rubles, they were defaulting in dollars. And whether that's Country Garden defaulting, whether it's PetroChina defaulting, whether it's Bank of China defaulting because they have US dollar liabilities, it's a real problem for China, and will eventually lead to probably Taiwan being more safe, and B, a continued more inward-looking China going forward.
Right. So, however, though, when it comes to China invading Taiwan militarily, do you think that looking at U.S. foreign policy in places like 1, Kurdistan, 2, Afghanistan, 3, recently with Ukraine, they haven't. So when they pulled out of the Middle East and Afghanistan, and then they didn't send troops to Ukraine. Obviously, they sent money, they sent weapons, but they did not send troops. And so, do you think
it's very different? And the common theme is nuclear weapons, right? The reason that there's no remember. The Europeans are doing, pardon my language, the Europeans are doing fuck all in Ukraine, right? There's no fly zones, there's no nothing, because Germany, let's get this straight. You're against the war in Ukraine, you're buying $1 billion worth of gas, $1 billion worth of gas every day from Russia. You won't send troops to Ukraine because you're worried about a nuclear attack, and somehow just sending a few weapons to Ukraine is being supportive. Right, and again, China is probably, China. The US engagement with China is probably going to be, if anything, comparable to that. Because again, I think whilst we can be skeptical about the quality of Chinese military hardware, which there is some skepticism, there's very little doubt that the Chinese have closed the gap to some degree with the United States militarily in the last 10 years. I think that's undeniable. But look, I think more importantly, the China, think about it like this: you're Xi Jinping, and you're ruler for life. Now, if you're ruler for life, you leave office one way, and that's horizontal. That's either by natural causes, or in the case of the Gaddafis and the Gaddafis and the Saddam Husseins and these sort of folks, you leave through
invasion and assassination.
Through me, well, you're killed, you're murdered, right? So you're Xi Jinping, and if you take Taiwan, here's your plan, right? If you take Taiwan and you win, right, you are in the history books, as you would have been anyway, but incredibly revered, right? If you don't win, family's purged, you're purged, you lose everything, and most importantly, from Xi Jinping's perspective, you are erased from history. Erased from history. Why would he take the risk? Unless there is a 100% chance of this being successful, why take the risk? Because if he tries to take Taiwan and fails, this occurs. If he tries to take Taiwan and there is similar dollar-oriented sanctions against China as there was against the PBOC as there was against the Russian central bank. Economic crisis, and there's a coup, right? You end up having a nuclear war with the United States. There's a coup, right? So unless there is a 100% certainty you can do that, which you can't make that, you can't have that, right? He doesn't go ahead and do it. He doesn't do it. And I think that's why, for me, I make the statement, I don't mean to be flippant, Taiwan has probably never been safer.
Mm-hmm. Got it. One more thing. So, Michael Pettis has done a great job about talking about how China's economy has been extremely reliant on debt. And so if you look at the way China's economy is structured, he argues that you need to improve the household consumption function as a replacement for whatever demand they get by raising additional debt. And do you think he's right on that? Do you think Chinese debt isn't sustainable? And so, or otherwise, what would happen?
But I push back a lot on this debt dynamic argument, right? So whether it's the Fed has to drop the balance sheet to 5 trillion. No, it doesn't. Japan's been on the verge of a debt blow up for 30 years, and it's never happened, right? China will not have a debt crisis because the debt predominantly is locally held, right? If China was to have a dollar crisis, for example, invading Taiwan and having lost access to dollars, it would hurt badly, right? But at the end of the day, the reason Japan never had a crisis, the reason that China has never had a crisis, because the lenders and the government work in lockstep to orchestrate policy, right? Now, do Chinese banks and Japanese banks have lower ROIs than US banks? Yes. But in terms of crises, Japan's been able to avoid a crisis when their debt to GDP level at levels that were deemed by many as completely unsustainable. Look, there's more, correct me if I'm wrong, but I think there's more aggregate debt in the United States per capita than there is in China.
I'm not sure of that figure, but yeah, if that is true, then that's crazy.
Right, yeah, because you've got state, you look at it, because again, you can look at federal debt, it's one thing. By the way, US has so much more federal debt than China. Now, that doesn't take into account state, it doesn't, local government financing vehicles, it doesn't take into account state, provincial debt and the like. But if you look at, I think, aggregate debt to GDP across government, semi-government, corporate and individuals, US is a more levered economy than China is, right? Because again, household leverage is much lower in China than it is in the United States. So look, at the end of the day, debt crises are driven when people call in loans, right? And if the local banking system is not going to call in loans, then you do not have a debt crisis, right? You can have a productivity crisis, you can have a growth crisis, but you're not going to have a balance sheet crisis in that environment, right? Again, as you alluded to, I've been doing this for a while, right? I can name, dozens of occasions and dozens of reports that I've read that this is China's Lehman moment, this is China's Bear Stearns moment, right? It just doesn't happen.
True, yeah.
It doesn't happen because the banks, because the China Construction Bank is not going to call in, is not going to put PetroChina into default, right? Because the government won't allow it, right? Now that'll hurt Bank of China's profitability, but it will allow PetroChina to keep operating, right? And again, I think but again, it's just a different model. If you put a Western credit model on China, it doesn't work, but it's not a Western credit model, right? It's a Chinese credit model, right? And you've got to think about it through that lens.
Right. And when you speak of creditors, one thing that I've been curious about, and this should be our last question about China, but considering the closed nature of the Chinese banking system and the powerful ability of regulators to be able to force the creditors to restructure, is this even a good thing in the long run?
What? Sorry, what, the closed nature of the system?
When the closed nature of the system into the powerful ability of regulators in general, do you think that is a good thing in the long run?
It depends on. It depends. Okay. look, ROIs in Chinese banks are going to be lower than ROIs in Western banks, right? But they are policy tools, right? So you should naturally assume that that's the case, right? That's going to be the case. Obviously, the arguments being made, which are, and look, the notion of JP Morgan having branches in China is it may happen in 10 years' time, right? But JP Morgan's been trying to get a banking license, a full-blown banking license with branches in China for 20 years, and it hasn't happened. American Express has been trying to trade in China took 20 years to get a license in China, right? These processes, they talk about the opening up of the banking system and say, foreign banks can now own 51% of a company. And then you read the fine print said, subject to state council approval. How many banks have been approved? That'd be zero, right? So it's all that, from that perspective, it's bullshit. So now look, I mean, would foreign competition help in a perfect world? Yes, it would, right? But I think that the bigger picture is about stability, and this goes back to the fundamental point about the Chinese the political economy. The most defining event of China in the last 100 years was the Japanese occupation, right? So the Chinese have worked out that they can control every facet of domestic society, right? Bill Clinton once said that controlling the internet was like nailing Jello to a wall. China nailed Jello to a wall, right? Because they can control the internet, and they can have economic freedom without political freedom, and do all the things that the Bush, everyone going back as far as Reagan said that they could not do, but they did do it, right? So they can control everything domestically, right? And that includes the banking system. So the banking system's there, right? Now, the one thing that they couldn't control was an external threat, right? Japanese invasion, that's why, going back to the Taiwan point, that's why China is going to look more and more inward and continue to de-dollarize, right? I wouldn't be surprised if there is a complete and utter moratorium on Chinese companies raising US dollar debt going forward, right? Because that dollar debt creates systemic risk that the Chinese can't control because it comes from abroad. So the notion of an inward-looking banking system that just runs inside of China, that can be okay, right? Now, I'm not saying Switzerland is that model, but there is a Swiss banking system that works very, very efficiently just in Switzerland, right? Now, obviously, the Swiss capital account's much more open than what the Chinese one is, but you get my point, that you can run these things inwardly. They may not be as profitable, they may not be as the ROIs may not be as high, but you can still run them securely, right? And that's obviously the number one goal of the party.
Mm-hmm. Yep. Moving on, I wanted to talk about climate, climate change, etc. And so, you recently started your new venture, Climate Transformed. And so, this is just to start us off. So if you look at places like FinTwit, and if you assume FinTwit to be the general market consensus, the broad view held is that one, the shift towards green energy, the shift towards climate change becoming an important part of energy policy is already here. And then two, a large part of that is going to be funded by uranium, nuclear energy. And a lot of what we're seeing in the EV stocks, for example, is bubble-like behavior, and a better place to park your money would be someplace like uranium. And do you broadly agree with that view? Do you agree with the idea that uranium is going to be spearheading the shift towards?
No, uranium's part of it. There is a global mix here, right? Because this is not a green revolution; it's a green evolution, right? And there's one stat that I come back to time and time again. So by 2030, I couldn't tell you if the world will sell 20 million EVs a year, 25 million EVs a year, or 30 million EVs a year. Couldn't tell you, right? Tell me how much lithium is going to be in the world. Tell me how much. How adoption rates are in the US and how charging infrastructure and all that stuff. A lot of variables, right? What I can be really confident in is that by 2030, there'll be roughly 1.8 billion combustion engines on global roads, right? 2-wheel, 3-wheel, 4-wheel and above, right?
Right.
They need oil and gas.
Yeah.
Right. So, the notion that there is somehow a revolution where we can defund oil companies and force change that way is just complete horseshit. We won't get to peak. The problem that we have with net zero by 2050 is that we're probably not getting to peak oil consumption until 2045, right? That is incredibly problematic for people who are, for Paris goals and all of the above. So, look, so as we transition from a global economy that has been revolved around fossil fuels for 140 years to something that's more electrified and sustainable, there are going to be numerous things that play a role here. I think uranium is and nuclear energy is very important. I think it is a most overblown narrative, right? This is, it's going to be important. It's not going to be the dominant energy source. It's just not, because you'll have wind, you'll have solar, you'll have hydrogen, you'll have tidal.
The usual argument against that has been that wind only works when the wind blows. Solar only works when it comes out, but uranium works all the time.
Yeah, it also takes 9 years to build a nuclear reactor. Right. So tell me what Chicago's energy needs are in 9 years' time, and we can start building a nuclear reactor, right? Where we can put wind farms in Lake Michigan, we can put solar panels on buildings, we can do all that sort of stuff today, right? So the arguments about nuclear, look, they're very valid. They're very valid. It is the cleanest form of energy. It's it is incredibly, it's safe in the small scale reactors that we're building today in terms of so all the small scale reactors are incredible. Safety's gone through the roof, but let's not overplay it as anything more than a part of the process, right? So nuclear energy can't fuel cars, right? Nuclear energy can't fuel planes. Nuclear energy can't fuel ships. Now, it can obviously charge batteries and all that sort of stuff. I get all that, but it's part of the process, right? And I do think it is, not a small part, but I don't think it's the look. Uranium and nuclear stocks are. It's a fin twit fad, not a fad per se, but it's something which everyone's obsessing about. It's interesting. It's part of the mix and part of the mix alone.
Mm-hmm. And so, from your standpoint, how do you see the whole, how do you see the climate trend sort of play out? So, where do you think investors should be looking in terms of investable opportunities?
So, Matt, I say a lot. So let me explain our model with Climate Transform. So we've broken the world up into 16 climate segments, right? And that's everything from carbon credits through nuclear energy. We do sustainable farming, we do supply chain optimization, we do biofuels, we cover the whole gamut. And the issue is, and I say this a lot, that everywhere you look is $1 billion opportunity, right? So my favorite section to focus on within those 16 buckets is supply chain optimization, right? Because it's a very much all-encompassing thing. And what do I mean by supply chain optimization? Well, every supply chain, from the garment industry to iPhone manufacturing to building homes to producing cars, has to find a way to decarbonize, right? Has to find a way to make their Scope 3, they're effectively 1, 2, and 3, but predominantly Scope 3 emissions to be net zero. Now, that will take a hell of a lot of additional electric power. So one of the challenges that we face is that we don't just need to replace oil and gas with power with electricity. We're probably going to have to double the amount of electricity we produce globally in the next 20 years to meet all this demand, right? So if a car goes from running from oil and gas to running on electricity, you got to produce that electricity, right? So you got to take all the oil and gas that is utilized around the world, electrify those engines, and use electricity to run those engines, right? So so every part of these supply chains has its own nuance, its own opportunity, whether it's whether it's sustainable protein in whether it's utilizing insect protein in cat and dog food, right? And fish farms. Does that sound boring to you? Right? Cargill thinks it's a $10 billion industry. Black soldier flies. Like, I mean, who the hell's? I heard of black soldier flies back in March. Black soldier flies are freaking amazing, right? Look them up.
Black
soldier fly larvae.
Black soldier
flies. Right? Cargill thinks it's a $10 billion business, right? Whether it's ways to decarbonize garments, whether it's ways to decarbonize iPhone, the whole thing. So the supply chain optimization thing, and what's so exciting for companies around the world, is you can have companies that can fix $1 billion problem, right? And there's thousands of these $1 billion problems that exist across so many facets of the way we make stuff, right? That for me is truly exciting, right? And then we obviously look at things like the role of carbon market, carbon credits, and stuff like that. I mean, that's a big part of what we're doing. It's a big focus of ours at the moment, because to get to net zero, right, until you've decarbonized your supply chain, you've got to buy offsets, right? And what do those offset markets look like, and the infrastructure around them? So no, I think that, again, I stick to the point. Everywhere I look in the climate space, there's $1 billion opportunity. And what I know is that the energy transition is not going to be a smooth one. You can't just transition an economy that's been running for 140 years on oil and gas and electrify those processes and expect it to go smoothly. But the opportunity sets is just incredible. And the exciting thing is the best minds in the world are going into this space right now. With all due respect to blockchain's is an absolute irrelevance in terms of the intellectual firepower that's going into climate technology right now.
It's interesting to say that. So how are you thinking through the digitization trend, which is another one of your mega thematics? So a lot has been made about how crypto, Bitcoin, the digital asset space has performed over the last, give it takes 3 months or so, or 3 to 6 months, where we see stuff like Bitcoin, Ethereum, etc. down considerably. You're seeing a lot of the fraud come out of the digital asset space. So how are you thinking through what's going on in digitization?
So let's be clear, right? Let's be clear, right? There are 19,000 coins in the world.
Yeah. 18,980
are going under. Right? Crypto's bullshit. It's complete fucking bullshit. I'm the ultimate skeptic on this. China could never ban crypto. China banned crypto, right? Crypto can't be regulated, right? It's the store of value arguments, bullshit. The comparisons will come in terms of a medium of exchange, bullshit. The fraud. Let's be really clear here. The fraud that goes on in this space is unacceptable in equity markets, credit markets, etc. Right? And it's the only reason it still exists is because governments are behind the curve and they haven't regulated properly. Right? I personally believe the coins will get regulated out of existence. Not that blockchain's not cool technology. Not that blockchain can't be used as part of, we're doing an interview with a VC firm in Europe next week, which is using AI and blockchain in regards to energy. It's sort of enhanced software on energy storage and energy efficiency across be the consumer goods all the way to huge industrial facilities, right? That stuff's really cool, right? And that's the digitization that I focus on. Crypto is not digitization. Crypto is in irrelevance compared to what you're seeing in incredible software, including what blockchain is doing for as part of this digitization process. So I've always been a skeptic on crypto. I think that it is. I think that the behavior of the guys of the likes of Michael Saylor and Elon Musk, who basically, these advocates who convinced guys your age to max out credit cards to buy cryptocurrency that couldn't go down, right? To buy stable coins with 20% yield, even though you didn't know where the yield came from, right? Yep. This shit's borderline. This shit's criminal in any other market, right? So, I think we've got to separate blockchain technology and the brilliant minds of blockchain right now from the coins itself. Because let's be clear, right? Yeah. You don't need tokens to implement blockchain strategies, right? The tokens are the pariah on the back of the innovation, right? And the fact that the conventional media still talks about, look, it's, I think we're very lucky that there's a lot of the systemic risk around the crash is not really there. It's a lot of really rich people getting less rich, right? But there also are a lot of guys your age who have lost everything, listening to the likes of Michael Saylor, the Michael Saylors of the world, who have been saying, what was his famous thing? Mortgage your house, mortgage your parents.
Mortgage everything, sell your business, buy Bitcoin. Yeah, that is, I think it's
disgusting. It's just disgraceful. And, I'm sure this guy's not sitting down with the parents of the 20-year-old kid who's now filing for bankruptcy because, taking that advice. And I used to worry that I'm just sounding like an old dude and get criticized for sounding like an old dude. I don't say this very often. I think I'm fucking right on this. I just challenge everyone to think that if you don't, like a great analogy, a great statement I once heard, if you don't know where the yield is coming from, you're the yield.
I will keep that in mind. I think that's a great statement. And also, so do you think we're also seeing some sort of a tail wagging the dog type dynamic? So, we see, for example, Michael Saylor, just to take an example. So he has repeatedly borrowed money in order to buy Bitcoin. So, his entire business MicroStrategy is pretty much just buying Bitcoin on debt. And so are we starting to see some sort of a tail wagging the dog in the sense that, MicroStrategy borrowing money, buying Bitcoin is actually, and, being that sort of a whale is sort of the dynamic that we're seeing that's actually holding the price of Bitcoin up?
Look, man, I'd say, look, again, I have no view on, I have no view on the price of Bitcoin because I don't think it has any value, right? So I would say, look, there's plenty of things you can trade, right? Trade Salesforce, trade Amazon, right? You don't have to trade. Find something with a comparable volatility that has a business model. So Anthony Scaramucci, often says that, well, Bitcoin's going to be like Amazon because Amazon was once $1 trillion company, now it's $3 trillion. That's where Bitcoin's going. Yeah, unfortunately, Bitcoin doesn't sell books, it doesn't sell shit, and isn't the world's biggest cloud company, right? So the notion that somehow there is an inherent value in Bitcoin is ridiculous. Now, I understand the scarcity value, right? But there's scarcity value in contemporary art. There's scarcity value in wine. There's scarcity value in property. It doesn't mean that we need to build an entire infrastructure around that. Now, do I think there's enough embedded leverage and there's more shoes to fall in terms of other stable coins going under and all this sort of stuff? Yes, absolutely, I do. I think that's coming. Bitcoin could be around, but is Bitcoin going to be as relevant as what the market and the media says it was? Absolutely.
Yeah, got it. Moving on. So the other one that I was very curious on discussing was demographics, and so when you think of demographics, a lot of people have consulted Peter Zahan's work when it comes to demographics, and so his broad idea has been that U.S. demographics, broadly speaking, are a lot stronger compared to demographics in other parts of the world. And so, how do you think that? The general trend of demographics has been lower, and so labor force growth has been lower. And so the last time we saw an exponential growth or not even exponential, let's say 10-20% a year growth. We saw that when the baby boomers entered the workforce back in the 1970s.
So you mean 10 to 20% equity market growth?
10 to 20. Like annual growth in the labor force type.
Oh, annual growth in the labor force, right? Yeah, I mean, look, demographics matter. Older people buy bonds; they don't buy stocks. Older societies are less productive because older people work less hard than younger folks.
And there are lesser people, so.
Yeah, and there's less in the workforce as well. I mean, I think the US obviously. Its demographic dividend is the continuation of a demographic dividend is very much dependent on immigration. And immigration has been a wonderful source of not just cheap labor but smart labor and and the like over the years. And I think that as the UK is seeing firsthand right now, if you cut back on immigration, you have growth problems. So it's very easy to sit there and talk about the UK struggles, which the growth troubles that the UK is having are being the Brexit problems are being well and truly clouded by what happened with COVID. But China, the UK's got a huge growth issue going forward because it's just, immigration is important. The place that I think that it does, obviously Europe has its demographic challenges. China, too many guys. The one-child policy is going to come back to bite. He's going to come back and bite China in the behind because you've just got too many guys. Not enough. There's not enough kids being born. I'm not saying that China's going down a path of Japan, but you could easily see Chinese population growth going negative in the next 20 years. That's probably not a bad thing because obviously you've got a lot of mouths to feed, and economies can only generally speaking, economies and societies can only support so many people. So I think that's part of it. But no, I think that the big challenge is obviously going to be, where there's a lot of talk about where demographics are negative, right? Obviously the places that have really constructive demographics are,
in Africa.
Africa obviously is very good call. India, Indonesia, Brazil, these sort of places, Turkey. The trouble is it a challenge or a curse where India has to find 10 million jobs per year to employ its graduates. These are real challenging things for India. But look, at the end of the day, younger economies, younger societies will tend to grow quicker. There's a great Renaissance Capital, which I think is the best frontier market research out there. Look at two main things to see a sign where you reach this sort of hump of economic development where you can have exponential, explosive growth. Let me get this right, literacy rates above 70% and electricity consumption over 250 kilowatts per capita. I think that's the numbers, right? If you go back to Finland in the 1880s, these numbers have worked incredibly well. So when people are, when the majority of people are smart enough to, or have the ability to read and have the ability to have electricity, these are the things which can be tremendously beneficial to societies over the long haul. So, but again, so we'll go through this back and forth. I mean, obviously deteriorating Western demographics, tremendously supportive young demographics in many parts of the emerging world. Europe's got its issues, but I think if there is one demographic time bomb, it's China.
Mm-hmm. And so from a demographic standpoint, so I'm guessing you're probably bullish India. And to an extent, so when you look at places like Africa, so when you put into proportion ideas around so African development, so you're seeing there's a lot of Africa tends to have corrupt governments, some sort of dictatorship, a lot of civil instability, etc. So when you look at Africa, so are there any specific countries that you find interesting from an investment standpoint?
But I think that you look at people do like Mozambique. Morocco is interesting. Algeria is interesting. Obviously they've got particularly in the context of Europe looking for alternate sources of power. Algeria obviously is a big exporter of natural gas, and you'll think that they'll be a beneficiary of that. Mm-hmm. I think that there's look, Africa does have its structural problems that we all know about. No, I think that look, big economies like Nigeria, there's a lot of untapped potential in these markets. But look, I mean, frontier investing has been a disaster for 20 years. There's a company called Red Wheel Capital, which is the best frontier and emerging market fund that I know of, based in Miami. They have a very, very good frontier fund, and you talk to Jim Johnson, who's the PM at that vehicle. It's amazing he has the hair that he has, because it's just it's just boom bust cycle after boom bust cycle, and it's for every on a volatility adjusted basis, you'd challenge yourself, you'd ask yourself, why would you even bother?
No, that's fair. And do you think a lot of that has been, so in the 1990s, so when these frontier markets, emerging markets, so roughly from the 1990s until 2008, we sort of had an expansion in, what you could broadly call the neoliberal ideology. So, increased amount of capitalism, free trade, free currency exchange, stuff like that. We saw a lot of that, flood through some of these emerging markets, the Far East, etc. So do you think that was and we're starting to, would you broadly agree that we're starting to see those forces reverse? We're starting to see a period of deglobalization.
Mate, I'm not a big believer in the deglobalization trend. I mean, just because the United States builds a couple of semiconductor plants doesn't mean it's deglobalizing, right? Look, I mean, there is certainly more nationalistic approach, and people are going to look more towards, particularly on strategically important sectors like pharmaceuticals and semiconductors and the like. And I think increasingly battery supply chain is going to be a part of that. But does anyone in the United States really want shitty garment jobs coming back to the United States? No. Right. So be careful what you wish for, right? Now, I get that the romance of the steel mill in Pennsylvania, and listening to too many Bruce Springsteen songs is something which is romantic to some people. But at the end of the day, economies evolve, right? Economies do evolve. Now, is the decimation of steel towns in Pennsylvania, is that the fault of China, or is that the fault of the US government who didn't see it coming? Right, and there was no efforts to, if I was to say the one great disappointment of the Obama administration was the fact that they didn't see the opioid epidemic coming. Right, the opioid. Look, China may have taken the steel plants and taken away the factories and done that sort of stuff, right? But the governments didn't see this stuff coming, right? So they should have been. There should have been additional training and education, all this sort of stuff that just didn't happen, and these communities went to rack and ruin. And that's one of the things which I think is vitally important in the energy transition, is that the reason Donald Trump got elected is because these communities were left behind. Right, now, it wasn't necessarily, it was a China thing, it was a climate thing, it was a bunch of these sort of things together. But if you're going to close down coal mines in West Virginia or northern Queensland or Sheffield or Mongolia, you can't leave these communities behind, or else you will have populist politicians like a Donald Trump get elected in these communities because other governments didn't give a shit about what happens to these communities. Change is going to happen, right? The ultimate sign of a functioning capitalist economy is creative destruction, right? But I think we've also got to appreciate that you can't allow these communities to be left for dead, or else there will be political consequences.
Mm-hmm. Well, thank you so much for a wonderful interview. Before we wrap up, what if you had to leave investors with 3 lessons? What would they be?
3 lessons. Always okay. And you said investors, right? So we won't put trading in here. So from the investment standpoint, is there's narrative. There's I think you've got to clearly define your timeframes with any investment, right? So the longer you can hold on to something, the greater the probability of your outcomes, of achieving your outcomes, because you're just not getting stopped out by noise, right? That's vital. That's vitally important. That's number one. Number 2 is to follow mega themes, right? Mega themes matter, right? When there will be times again and again and again where AMC will be the lead story on CNBC for 2 weeks straight, and we shouldn't give a shit about that, because it's not one of the things that truly matters, right? Which truly drives whether it's climate change, whether it's mapping genomes and stuff like that. So if you're going to focus on something structural, focus on something really, really structural, and follow the mega thematics. And B, never use leverage. If you're, the reason people get stopped out isn't because, in many cases, their ideas are bad, right? It's because they use leverage. And I go back to this time, I think the number of Paul Tudor Jones, in terms of the number of trades he gets right versus wrong, it's 42% he gets right? Which, if I was cheeky enough to walk up to him and say, why don't you just use the same risk management and flip a coin? But I wouldn't do that. But I mean that the leverage is the thing that people who don't use leverage don't go bankrupt. And leverage, be that in crypto as we're seeing now, whether it's in whether it's in, in stocks, whatever it is. If you don't, you won't go under. If you don't, you won't go under if you don't use leverage, right? You'll leave something on the table, but from a risk reward standpoint, it's a far superior outcome.
Got it. Paul, thank you so much. So, where can investors find, or where can our listeners find you and more of your work?
But climatetransform.com is the main place for us. That's the main place. I'm not a big Twitter user historically, but climatetransform.com is where this is where we do produce 500 hours a year of interviews on climate change and the investments around climate change. So, generally speaking, you get me there.
Awesome. Thank you so much for being on the podcast, Paul. It was awesome talking to you.
Thanks, Reed. Thanks. All the best.